Good morning and welcome to 5 Before the Bell, TheStreet.com's daily market preview and global market update right here from the central London studios of Core TV in the heart of the financial district. I am Martin Baccardax, the London Bureau Chief here at TheStreet.com, and I'm going to take you through those 5 things you need to know before the bell. We're deeply into the summertime throes, it has to be said, with a little bit less liquidity than we would normally see, and therefore you're seeing some strange things happen as a result. But nonetheless, we are looking at a pretty healthy rebound, and the Dow is called up triple digits. But let's take a look at what's happening in Europe at the moment, because we are seeing green across the board, and as I say, healthy equity gains. And that's always welcome, even if you are looking at thin volumes. Now, banks are leading the charge here in Europe, and I do always think that that's important. Whether it's a reflation trade or whether it's a trade that reflects investor optimism about economic growth in the second half of the year, it's difficult to say. We're bereft from ECB headlines this week, of course, and probably into next as well. So the reflation trade might not be the reason, but the growth prospects are still very solid indeed. And we are seeing 3.5% gains at some stage today for Deutsche Bank, Commerzbank, and certainly other, and 2 to 2.5% gains for the big lenders around the region. We had a solid session in Asia. I'll talk about Japan in just a moment, but we actually had one of the best gains in a couple of weeks for the broadest measure of Asia shares. Japan's second quarter GDP number was an absolute burner. 4% was the annualized growth rate, and there were some markups on previous quarterly impacts as well. Much of it, though, is down to some arithmetic changes and the fact that consumer spending from a comparable basis is really, really strong in this quarter. Now, whether that is going to be achievable and sustainable in the quarters ahead is something that investors are asking right now. But nonetheless, this is an excellent piece of evidence that the decades-long central bank activity in Japan is starting to give some results. We didn't see Japan rise, though. Actually, the Nikkei 225 fell about 1% on the day. You'll remember that Friday, the trading session was closed owing to a national holiday. There was a little bit of catch-up today, and I think the fact that the yen was trading stronger against the U.S. dollar held down gains for the export-focused benchmark, and therefore we saw the dip that we did. But we are going to watch that one with interest in the coming days, because as investors plow back in, there's very likely to be a kick to the upside from that GDP figure. Okay, let's move on and talk to something that's had a massive kick to the upside, and that is Bitcoin. The last I looked, we were trading over $4,200 for each of the cryptocurrencies. That is an all-time high, and that extends the year-to-date gain to, get this, 320%. And I am reading those figures correctly. It's an absolute astonishing performance for a piece of architecture inside internet commerce that many people have dismissed as a fad, and even worse, as a scam. It doesn't appear to be either, and we do seem to be gaining as we speak. Now, we've talked about this in the past, but there was a rollout last week of a new Bitcoin blockchain spine, if you will, that is going to sit parallel to the existing Bitcoin blockchain. It's an effort to ease some of the pressures in transaction times that many investors are growing frustrated with. Now, it's a bit of a controversy in the sense that removing some of the data to an alternate platform will raise questions about its bulletproof appeal with respect to hackers and other things, but it will certainly speed up the processing times. And the fact that it does seem to be working in concert with what was promised is certainly a cause for optimism from those who think the currency is the next new thing, and that's part of the reason why we've seen some of the big gains. Now, Coinbase, which is a digital exchange provider, is also part of this story because it raised about $100 million in a fundraising effort last week. And it's actually linking up with Fidelity in a way that will allow investors to look at their Bitcoin wallet in parallel with their traditional investment accounts. And that's a really big step in moving this cryptocurrency into the mainstream. And I do believe, again, this is part of the reason that we're seeing the price increases that we are. Now, many people are comparing this to the internet bubble and even to worse, to the great tulip crash of the 1600s. I don't actually believe that's true. That's not to say that we're not going to sway from pillar to post in terms of pricing. But when you consider the fact that there are only 21 million Bitcoins that are ever going to be in existence, according to its creators, and only 16.5 million have been mined to date, it does suggest that when we get to that 20 million cap, If indeed the infrastructure can be created to allow the coins to trade in a quicker and more efficient way, then you can only imagine that the price per coin is going to rise if demand increases. The fundraising from Coinbase, for instance, is a way that people think will allow marketing spending to increase and therefore drive more investors into the currency as we see it now. So the fact that you could grow a tulip at any time that you want probably meant that the tulip bubble was coming to an end at some stage. But here, I don't think any of us can create a bet coin, although many people are trying to create parallel coins with Ethereum and others. Now, whether those are going to take over is a question for you to answer and not me, but nonetheless, I am growing more and more of a convert to the reality of Bitcoin than I was even a few months ago. And it's not simply because of the price. It's simply because of the way that it's becoming more and more entrenched into traditional investment platforms. Fidelity is one example, but the Coinbase is also going to push it into institutional places as well. And I do think that's important to mention, but we're going to watch this with interest. And we're looking at $4,200 for Bitcoins right now, which gives Bitcoin a market cap of 68 billion US dollars. And that's bigger than UBS, and it's bigger than Credit Suisse and the Royal Bank of Scotland combined. Absolutely incredible story, and one that isn't going to end today. Okay, we're going to move on and talk about Netflix. This is an interesting one too, because we are looking at the price war, if you will, for talent among the streaming providers as they trade and move into some of their new business propositions. You'll remember that Netflix is going to try to create new and exciting content on its own rather than to be reliant on studios to do that, because of course the prices for this content is beginning to rise. The Wall Street Journal reported this first, and it is official. Shonda Rhimes, who is the creator of Scandal, Grey's Anatomy, and some other terrific hits for ABC, is going to move her Shondaland production house into Netflix and out of the Disney studios. This is a major coup for Netflix, which is, of course, signed on the Coen brothers of late, as well as David Letterman and all sorts of others, in a way to create original content that is going to be on its platform alone. They have to find a way, of course, to entice new customers, keep the ones that are already there, and make sure that Amazon doesn't poach them when they upload and sort of accelerate their Amazon Prime service. Now, Ms. Rhimes is an incredibly talented content creator, a scriptwriter, a producer, a movie maker, whatever you call her. She is certainly one of the gems in the kaleidoscope of Hollywood stars. According to the Wall Street Journal, who is citing sources that are familiar with the work, she is worth about $2 billion in ad sales and licensing to ABC as a result of her creations. Now, taking over that kind of firepower into Netflix is going to go a long way into ironing out some of the concerns, I should say, that investors have had about the cash flow in the group and its ability to maintain servicing of the debt levels that are sitting nearer at 20 billion US dollars. And of course, it needs to borrow that money to create the new content. But if it can do it on its own, it might be able to do it more cheaply, and it might be able to do it in a more exciting fashion. So this is an interesting development. Disney, of course, is going to have to suffer the loss of this, but they're moving in a slightly different direction in terms of not necessarily wanting to create new and exciting content, because they do that pretty naturally, but of course to create their own online platform. So the cleavage that you're seeing between the Netflix and the Disney business propositions is interesting to me, and it's actually been one of the reasons why these stocks are more and more active as the days go by. Netflix is called a little bit higher at the moment, actually I do beg your pardon, it's called about 0.5% to the downside, but it's still up around 39% year to date. One stock that's called modestly to the upside, and that's thankful for investors, is Penney. It's going to look like it'll have a little bit of a bounce at the open today of about 0.25%, but nonetheless, we are looking at significant declines of over 43% so far this year, and a great portion of that came on Friday, 16.5% to the downside after the company revealed its second quarter figures. It's worth recapping. I'm sure you've seen them, but nonetheless, it was a 9 cents a share loss when you excluded some certain items, 20 cents a share when you didn't, and that was much steeper than Wall Street had anticipated. Like-for-like sales, they were down 1.3% on the quarter, and actually JCPenney was one of the few stores that wasn't actually getting some like-for-like traction into the second quarter, maybe because they were liquidating so much of their portfolio and they were seeing such a heavy margin hit at the same time. 127 liquidations, as it turned out, and 140 store closures to come. So this company has a long way to go to steady the ship and to entice customers back in. Now, they're not the only one that's having this problem. Of course, as we know, the retail landscape is changing every single moment Amazon is eating the lunch of the traditional providers, and of course, it's just becoming more and more difficult to entice shoppers into the big retailers because they are finding what they need either online or in specific single item retailers all around what we would call the high street here in the United Kingdom. Now, the problem with JCPenney is compounded a little bit because their balance sheet is weak to the degree that it probably impedes its ability to invest in new platforms going forward. And even if it did, and even if it were able to grow its online sales even more rapidly than it already is, what many retailers are talking about is the surge in shipping costs and how heavy a burden that is on the bottom line of these companies, because you simply can't just grow your online business for free. You have to get the customers their product, and you have to get it on time, and you have to get it cheaply because there's so much competition. Therefore, the shipping prices are significantly higher than they have been, and it's a cost that's weighing on the bottom lines of all the retailers, including JCPenney. We're not talking about this stock going into the penny stage just yet, but nonetheless, it does have a titanic task in the second half of the year. Its guidance was relatively weak, and investors are certainly not convinced that it's able to turn things around in the near term. So this is one that I would suggest you proceed with extreme caution in the next 2 to 3 months until they further articulate the business plan and how they're going to arrest some of these cost increases and bring back some of the lost customers. Okay, let's take a look at where we are going to open on Wall Street, because it looks like a triple-digit gain for the Dow Jones Industrial Average. 111 points is what I'm seeing to the upside right now. Now, the NASDAQ actually might do well too. 38 points to the upside is what I'm seeing, so that's about 0.7%. Some of the chip makers are going to do well as a result of this cryptocurrency surge. AMD and NVIDIA are called significantly to the upside, so watch those at the opening bell. Apple is also called up, the last I saw as well. There were some decent numbers out of Foxconn, the provider and the assembler of the iPhone in Taiwan, which are part of the reason I think that we're seeing a kick up to the upside. 1%, as it turns out, for Apple at the opening bell. Keep an eye on oil. It drifted about 0.5% in overnight trading. There were weaker than expected refining pace out of China was part of the reason, but I think the strong U.S. dollar kept some of the oil prices down too. And as I mentioned, the strong U.S. dollar, it's just worth noting that we are seeing some weird developments in global financial markets simply because the August volumes aren't nearly as robust as they typically are. So even though you are seeing investors come back into risk positions, you're seeing the dollar corresponding rise. That's not the typical case, particularly when treasury yields are also rising as well. So there's some different mechanics going on at the moment as a result of the thin trading, but nonetheless, you are going to see a very healthy gain for Wall Street at the start of trading today, and it'll be interesting to see whether that carries on into tomorrow and indeed through the rest of the week as more and more of us head off to our summer break. Well, that's it for us here from Central London and Core TV. I'm Martin Baccardax, London Bureau Chief at TheStreet.com. Thanks for watching 5 Before the Bell. We'll see you tomorrow.